our fourth session, and this is on empowering startups and investment opportunities. The funding winter for startups has not completely lifted, with the deal flow still trending down since 2023. Have startups in the logistics sector fared any better? This session will delve into the unique challenges and opportunities faced by logistics startups, ranging from managing cash flows to investing in technology. Additionally, the deliberations will cover various funding sources available to logistics startups, including venture capital, angel investors, and government subsidies. So please put your hands together and welcome on stage our speakers for this session. Please welcome Mr. Suresh Bansal, founder and CEO of DCGPAC. Please welcome Mr. Anant Bhatia, CEO of Bhatia and Bhatia. Mr. Raj Attri, Executive Director, CCI Group. Mr. Shailendra Khinda, Associate Director, Anand Rathi Group. And this session will be moderated by Mr. B.L. Bajaj, Chairman, Dynamic Orbits Consultants Pvt. Limited. I'll hand it over to Mr. Bajaj to steer this discussion.
Good afternoon. I think this drum beating session and two enlightening conversations post-lunch have helped keeping the audience awake in spite of tea still not being served. And thanks to the audience for their patience. We have heard a lot since morning, but ultimately it's time to talk about some money. Ultimately, every business has to generate cash, and we have to talk about finance. Everything else is secondary. So I think timing for this event is quite appropriate. The industry is having a lot of tailwinds. The country's economy is doing well. And most importantly, within the economy, the kind of push which is there for manufacturing and infrastructure sector currently, I think we have not witnessed since independence of this country. The Make in India, PLI schemes, China Plus One, and very strong disincentive to import products and to incentivize to produce the same stuff in India. This is resulting in a significant momentum growth in the manufacturing sector. And on the other side, we see a lot of push on infra, the ports, airports, roads. That's all creating a very conducive environment for the industry. And the scale of operation has also increased multifold, which is providing opportunity and challenges for the industry. Now, this kind of probably event will help us in brainstorming. Are we geared up to take this challenge and face these opportunities and encase these opportunities? What we need to do, what we have done. Do we have enough resources? The industry has transformed a lot in the last 20 years. The kind of entrepreneur we see, the startup culture, the scale of operation, the use of technology, the face of the industry in the last 20 years has changed a lot. And I think the one important part of the whole change is the availability of money through different mechanisms. Earlier, the bank funding was probably the only source. You want to buy a truck or you want to create a warehouse, you go to a bank, take a loan, or there were some small NBFCs, and you go and take a loan. And one important thing which has changed is equity as a source of funding. Now today, every startup, every small company, or every growth stage company, or every large company is using equity as a source of money. That's very interesting, and that has provided enormous opportunity to capture value which is there in the system. Now the question is, and we have some very enlightened speakers today who will probably guide us on that. Now, selling equity, this thought is probably in every entrepreneur's mind. But the question is at what value? And that drives to the question, what drives value? In our profession, we meet a lot of people every day. They come to us that we want to raise money through equity, but then we talk about valuation, probably their expectation would be to the companies who would command highest multiple on the stock exchange. Where do we get there? There is nothing wrong in having that ambition. But what makes the difference? What drives the valuation if you are intending to sell equity? And whether it is just financial numbers, whether it is corporate governance or management or technology. So let's start with this as first question. And I would like to start with Mr. Suresh Bansal. Bansal Sahab, you have significant experience in the industry and you have seen different phases of evolution of the industry. What do you think when you are talking about selling equity, whether minority to a strategic partner, to a private equity fund, or to public market? What do you think? What are the drivers for the valuation? Why a company is valued less or more while being the same business?
Bajaj sir, thank you very much. Actually, I am not the professional advisor, but I will only share my own journey because I have gone through all these phases and the question which you raised. So, right from taking an investment from family office, going IPO, selling a listed company to Birlas, then dealing with strategic partners in DTDC, buying companies, selling companies, and similarly, in my new business now, I have the entire gamut of funding and equity sale, where we have taken seed money, we have taken family offices, we have venture capitalists, and we have the debt funding also. So, various options are available for all kinds of logistic companies. It all depends at what stage and what size they are. Okay. So if they are mature organization, of course IPO is the first option for everybody. If you're a profit making, you are a mature organization, then IPO will give you substantial capital, but it's a highly regulated scenario. On the other hand, if you go to private equity, you get a little bit less valuation, but you get a lot of advice, you get strategic inputs, and you can build your organization on their advice, you can do networking, but they also put a lot of pressure on you. So it's your decision how and who you want to go. Coming to the valuation, it's not what an investor will pay you. It is what you create as a valuation. I think creating valuation is a completely different game. From the day one, as you start the company, or even if you started a company, if you know today also how to create valuation, then the journey starts from that day. So there are a lot of check boxes for creating a valuation, and your valuation depends exactly on what you have built as an organization. How valuable it is, it depends on so many parameters. For example, your past profit, revenue growth, your profit growth, your margin growth trajectory, your future growth areas, and overall whether you are completely compliant organization. Now the social environment and the governance has become a very big piece. A lot of valuation gets tagged to the ESG, especially. Also, apart from that, how strong management team you have kept, what is the quality of the founders, these all drive the valuation for every company. So I think you must go to some good advisor like people sitting in the left of me, and they are the people who can tell you how to create the best value for your company. Thank you, Bajaj sir.
Great. Thank you, Bansal Sahab. This is what you call real life experience. Let me come to you, Mr. Shailendra Khinda. You are highly connected with the stock market and public market transactions. Now, when we see a public market, there is a company which is valued at a P multiple of 10, and there is another company in the same industry which is valued at a P multiple of 50. What is the difference? Because when we talk to entrepreneurs, they would all aspire to be in the range of that 50. So how do they reach to that level, and what makes the difference between a company commanding a multiple of 10 and a company commanding a multiple of 50?
Hello. First of all, thanks a lot, Bajaj sir, for inviting us. I think from an investor point of view, because I represent on the other side of the table who gives the funding. So what normally we look at the management team. That's very important. And these days the focus is mainly on corporate governance. What kind of systems, what kind of procedures, what kind of team, like, as Bansal Saab has rightly mentioned, the team is very important. And what USP you have, whether you will be able to sustain that USP when the company become large. That's very, very important, because when you're a small company, it's very easy to maintain that culture. But if you become a large company, how you are able to manage that culture, that USP, that is very, very important. And what we look is that how you are able to sustain that high growth, because P is the function of price upon earning. If your earning keeps on growing and there is a clear visibility of earnings, then I think you can command a high PE. So that is very important. First is corporate governance. Second is system and procedures. And the most important thing, what kind of future leadership team you are building. Because these businesses, if you see the businesses, it started with one-man show, but now they are in the hand of professionals. So this is how you create homogeneous, homegrown leaders. That is very, very important. So these are few criteria. I think it's a very complex thing, but I just try to summarize the key pointers which we look at when we are funding any startup.
Great. Thank you, Shailendra ji. Thanks for the insight. Mr. Attri, I think your group has seen how to create value, how to exit, how to have joint ventures, and probably you meet investors every day in your profession. What is your experience? What has helped you in creating value within your organization? And when you meet investors, what are their expectations when they try to value your company or put a value to your company?
Right. Firstly, thank you for the opportunity. Am I audible?
Yeah.
Right. So we as CCI, we represent both the sides of the table. There are cases where we try to take investments from private equity, and there are cases where our family office also invests in a lot of companies, right? So when it comes to valuing a company, I think there are many matrices to it. First is how strong is the founder or the co-founder in the company. Second is how strong is the business model, how solid is the business model, and how strong are the financials that they're willing to maintain. There are other matrices like the revenue of the company, the EBITDA that they're generating currently. And also, when it comes to valuing a company, effective storytelling by the founder or the co-founder, I think it plays a very important role, because when you're funding a startup, you don't know where it's going to reach in the next 5 years or 10 years. So effective storytelling by the founders in terms of what the company vision is, or how are they going to aspire to achieve that vision in the company, I think that helps a lot in terms of raising funds.
Very interesting. So I think great insight. Another question I think which is in the mind of every entrepreneur, everybody wants to grow, and to grow you need money. As I mentioned earlier, historically the bank and some small NBFCs probably were the only source of finance. Things have evolved a lot in last 10, 15 years, and now there are multiple options, and that is, I think, very useful and very helpful for the industry to raise resources. Now we have new age fintech startups, we have family offices, we have NBFCs like Bajaj and all, which are larger than several banks. And we also have these platforms like REITs and InvITs. So another interesting question probably where I would like to be enlightened from the speakers, what are the different modes of finance which are available for the logistics industry beyond the routine bank funding where they could look for when they need resources for their growth? So let me start with you, Mr. Anant Bhatia. You are in the profession and you are helping a lot of clients in these processes. What do you think? What are the new age options beyond the bank funding for the logistics industry which can be tapped for their growth?
Thank you, Mr. Bajaj. So, friends, I'll just start by sharing a very small story. This story dates back to 2009. One day, I received a call from one of my professional colleagues, and they said, "तूने Zomato का नाम सुना है?" I said, "सुना तो नहीं है कुछ खास पर आप बताओ." So they said, "There is this company which is coming up with a very interesting business model. Can you meet the founders?" I said, "Okay, we'll do that." And I took my vehicle and reached. He said that they are actually working out of a farmhouse in Chhatarpur. When I reached over there, I had the golden opportunity of meeting Mr. Dipinder Goyal. He was in a t-shirt and shorts and playing football along with his colleagues. So immediately when he saw me, he came and he said, "I have exactly 15-20 minutes. Can we have a quick chat?" And I will tell you this, he spoke about several instruments for raising funds, right from convertible preference shares, CCDS, which is convertible debentures, convertible notes. He spoke about safe agreements, which is a secured agreement for allotment of future equity. So he spoke about multiple instruments in 2009, which even me as a finance professional, I was in my earlier days then, had not even heard of or had barely, scratched the surface. So friends, historically, if you look at it, the modes of raising funds were two, broadly, if I were to bucket them up. One is debt and one is equity. Now, debt also has now various connotations in the new age startup regime. But if I were to talk about pure play equity, in the earlier phase of a startup, many investors are wary of actually taking equity upfront. They prefer something like a safe agreement, which is an agreement for an allotment of equity at a later date when a funding round happens, or investing in a convertible debt or a convertible note. So what is the essence of a convertible note? It is a debt instrument. It will attract a coupon, so you can take an interest on the debt till the time it is compulsorily converted into equity. And at the date of conversion into equity, there will be a valuation metric that will be applied to it. So these are the broad, criteria or the categorizations of the instruments that a lot of the current investors and even investees are actually looking at for raising funds. Again, it boils down to the fact at what stage of maturity is the startup at. If the startup is at a very nascent stage, even the investor and the investee both prefer for a convertible instrument. Why? Because if, let's say, for example, there is a startup which has just, let's say, commenced its business or is pre-revenue, they have a very nominal paid-up share capital, sometimes 20,000, sometimes 1 lakh, maybe 3 lakhs. Now, if you have someone from whom you're raising funds to the tune of, let's say, a 2 crores or a 50 lakhs also, they will actually eat up your entire capital base. So that is why these convertible instruments are very, very important, and they are very watertight in terms of their execution.
Thank you, Mr. Bhatia. Bansal sir, based on your practical experience, beyond bank funding, what are your options to raise money from a logistics industry perspective?
Just so I will give you my recent experience. In the startup company, when we wanted to raise some money, the first stop was to my friends and family, which should be the first stop for any startup company. That when you are experimenting, when you are growing, when you want to do the proof of concept, you want to showcase that you have done some business model, you must rely on your own money or on your friends and families, who should be the first, first call basically. After that, we went for the seed money. When we went for the seed fund, exactly what Anand Sahab has said, the investors offered us the CCPS. These are compulsory convertible preferential shares, for which there was a floor value fixed, that this is the floor value which they were very comfortable with, which I was not comfortable with. So I said, nothing doing, I will not sell at this price. They said, no worry, if you are promising you will deliver such and such number, then we will have a upside and we will convert this CCPS into an equity at a higher price. So they had put a floor value of X money and they had put a up value or the upper limit at 70% higher than the floor value. So over the period of next 12 months, we were to execute a plan which was as per what commitment we made, and we reached the highest of the valuation, and we were successful in converting our floor value into the upside. And therefore, we got the valuation what we wanted, and investors got the valuation because they now have a confidence the company is growing. So that's an actual story. Thank you.
Great, wonderful. Uh, so, Mr. Attri, I think you said you are on both sides of table. So you are definitely in the middle of something where the money is available beyond the conventional banks. So, what is your take on this? What are the options you would recommend for the industry where they can look for money other than the normal commercial banking channels?
Right. First is definitely your equity sale in terms of privately selling it to venture capitalists, or you have a secondary sale transfer, or if you're mature enough, then you go for a public offering, right? And otherwise, as Mr. Bansal said, it's the first option is friends and family. That is but obvious, or you go for debt funding. So under CCI, we also have a logistic and industrial park vertical where we currently own and operate about 7 million square feet of industrial and logistic warehousing space across India. So in that part of the business, we also have REITs and InvITs, right? And when we see the response of REITs and InvITs from institutional investors, from HNIs, right, it is tremendous. The kind of money that flows in through REITs and InvITs for this particular asset class is remarkable, right? Somewhere that shows the response, or that gives confidence on or it recognizes the constant cash flow that is there in the logistic and industrial park business.
Bajaj sir,
Great.
can I add something to what Mr. Raj
please.
and Mr.
Please,
Bansal has said?
please go ahead.
So I think this is with regards to the private equity. I think from an entrepreneur point of view, you should not only look at the financial side of it. Any private equity player comes and give money to you, you should also look the what value add it's giving to you. That is very, very important. Because if somebody comes as a financial investor, they will only look at what returns they are getting. 20, 24%, exit, put option, all these things. But the person who is coming with a rich experience, and mainly these global players, so they can help you in reaching the next level. So I think that's very, very important when you're raising private equity. Don't just look at the financial partner. Look at the private equity player who can add value to you and who can get you to the next level of the growth. That's the small thing I wanted to add.
Yeah, great comment. Great comment. Thank you, Shailendra ji. Yeah, please. Anand, want to add something?
So I'll just give a recent example. All of you out here would have heard about Ship Rocket.
Mike.
And it's been a story that has been going on for a very long time, that Ship Rocket is going to be going public very soon. Now, very few people know that Ship Rocket recently had acquired a company by the name of Picker. Picker and Ship Rocket were competitors to a great extent, though Picker was in a slightly different customer category as compared to Ship Rocket. But broadly, the categorization of the service offerings were broadly similar. And they were competing all across the spectrum. Now, how did Ship Rocket acquire Picker? And not for a small amount, for almost 200 million US dollars. Because they had the same set of private equity investors which had invested in both the companies. And when the conversation happened with the management of Ship Rocket, they planted this idea that Picker has a lot of service offerings which are complementary to your service offerings. So don't look at Picker as competitors. See how jointly you can make 2 + 2 = 5 or maybe 6. And that is a classic example of the value addition that a strategic investor brings in. So rather than looking at a pure play financial investor who's just looking to max out and look at an exit at a later date, the idea should be to onboard a strategic investor who truly understands the business, has a global ideology about how business has to be conducted, and opens doors for the investee company.
Great. Thank you, Mr. Bhatia.
Sir, I would like to add on what Mr. Bhatia said. So we've done this very recently. There's a Noida-based startup, and since we are in the development business, the company is called Indosub. They are a building material aggregator company, which goes hand in hand to what we do. So we develop assets. So we need a lot of building materials. That's how we've invested in that company. We picked up about 25% stake, and half of their order book is filled by our orders. So that's how it's a strategic partnership that we've done. So that is one way of raising funds, where we pick up equity in terms of partnership, and we also increase the value of the particular company.
Yeah, lot of interesting thoughts and lot of interesting observations. Very helpful. Thanks, the panelists. Now, we talked about raising money, but raising money is only the beginning. That's not the end. We have to manage the money well. And that brings to the question of financial management. Today, the scale of operation is no longer what it used to be 20 years back, where it used to be a one-man show. The owner used to manage purchase or sales or finance or operations or whatever. Today, we are talking about large organization, thousands of people working, 100 locations, multiple customers. So the complexity of business has increased multiple, and the amount involved in the business, the numbers have completely changed what it used to be 20 years back. So that the financial management, the management of money, and particularly also, if you look at in the current scenario, the working capital cycle has become very long, because all the customers, they want to use your money to fund their working capital. And even the input cost, whether it is in terms of fuel or people or rentals, those costs are increasing. So the in-house financial management is absolutely become very critical once you raise the money. Otherwise, we have Bajaj and a lot of other stories around where there was a huge money, but we couldn't even make a mess. So let's try to understand this dynamics from a financial prudence or financial management point of view. Mr. Bhatia, when you look at various companies in the process of management audit or in terms of when you advise them on the cost optimization and all, what are the things which you observe that a lot of companies are not doing right or they should do right from a financial management point of view?
So, sorry. You asked Bajaj. So, Bajaj sir, I'll give a very simple answer to this. So, whenever I'm sitting with any client, let's say it's a promoter-run company, where typically there would be, let's say, a father, maybe his brother or sister is also involved, and then the kids, the second or third generation is also there. The first and foremost thing I tell them, don't claim to be experts on finance. There is a common, and I will take the risk of saying, because I know there are a lot of very esteemed promoters sitting in this room, and very, I would use the word, people who with a lot of intelligence, people with a lot of depth. But the truth of the matter is, in 2024, the era that we are in right now, leave the finance to the experts. A promoter comes with, they have some key responsibilities as the owners of the business, which is running the business, operationalizing the business, onboarding customers. And finance today in India is a very challenging and a complex, subject. There are a lot of bureaucracy still involved. There are a lot of pitfalls. So what I tell them is, you have to ensure that you have a very capable CFO. Now, I'll give you an example. Recently, I was in Haridwar, and there's a manufacturing setup over there where they have a CFO, but the CFO spends the entire day only addressing GST, income tax, and those compliance matters. Now, that is not the role of a CFO. The role of a CFO is effective and optimizing of the financial management process, is ensuring that the funds are deployed in the best possible manner. The investments are yielding the desired results. And all the compliance framework within the organization are being managed with utmost governance. So now, friends, it becomes imperative that when you have experts, you have the best professionals, It helps in streamlining the financial function. Now, coming to the other side, which is, I would say logistics also in the last 5 to 7 years has undergone a massive change and a massive transformation. Logistics is not about now, just being a trucker or running a warehouse or probably, let's say, being into logistics. It is about how you integrate technology. It is how you actually make the whole process more effective and efficient for yourself. So my submission to all of you here is, and here is where the real dichotomy comes. Because on one hand, all these modern day technologies and technological advancements like AI, machine learning, it could be blockchain, while they're very good, but they're extremely capex intensive. And they also do not yield an ROI as on the next day. Sometimes it takes not only one, but maybe multiple years before the organization sees tangible benefits. So it's imperative that the organization starts planning for them, because these are the technologies that will ensure that the entire financial management process becomes very, very optimal. Otherwise, every process is going to be very human intensive and not yield the desired result.
Yeah, may I
Yeah,
just
Bansal sir,
add,
please.
Bajaj sir, what Bhatia sir has said is absolutely important. But what we did in DTDC when I came back from the US in the year 2006, I learned only one thing in America. Cash is king. Cash is king, and that's what we took in DTDC, that let's work on our cash flows.
True.
Yeah, are you generating cash? Is your operation generating cash? Are you having net cash available better than the last month, better than the last year? Then you are a strong organization. So one single discipline, that cash is a king. Always remember this. And as long as you have the cash in the bank, you're a strong organization. That's the first thing. The second thing we did as a principle, that we will not invest money, a borrowed money, on a long-term project. That's the learning we have done, that we will never borrow a short-term money for a long-term projects. So we will either make profit and invest, or we'll take investment and invest in long-term projects. Fortunately, till date, we have been profitable, and all the expansion has come from the profits. Thank you.
Great, thank you. So I've been.
Bajaj sir,
told
can I
to-
add something to what Bansal sir has said?
Yeah, only thing I have been reminded to close the session in 5 minutes.
Just give me 2
So
minutes.
be mindful
Yeah,
of
2
that.
minutes. So I think I fully agree with what Bansal sir has said, that cash is king. And I give example of Aditya Birla Group. So it's a big conglomerate. And what used to happen in this group, there were a lot of sister companies. So there was a free flow of cash from one company to other company. And when the cash, you get a free cash, then you don't value that cash. So what they did, so then they decided a system called Padta system. Padta system means, for example, me and Mr. Raj, we are part of a group. I need money. So I have to go to the chairman and I have to present the case to the chairman that why do I need money, and then give a full case study for that. And then if Mr. Raj is a cash-rich company and I need cash, then he will lend me cash at interest so that I value that cash. So I think that is very, very important. Professional management of cash flow is the key. Thank you.
Great. So in the interest of time, the last question I will request panelists to answer just in one line. Today, there is a lot of talk about startups. And in the logistics industry, we have seen large number of startups, some highly successful and some miserably failed. So if you would fund a startup, please answer in one line what you would look in that startup if you want to put in your own money. Start with Bansal sir from this side. One line, please.
Quality of the founder.
I would second Bansal Saab on this: management team and quality of the founder, hands down.
Same here. I mean, I would just hear how convincing the founder's story is and how desirable he is to achieve the problem that he's solving.
Walk the talk.
Great. So ultimately, it boils down, you fund the people, not the company. Great. So We have time for just maybe 2 or 3 questions. And please let us know whom you want to ask, because we have great panel here. Anybody? Great. So the explanation, oh, sorry, there's one. Otherwise, I thought the explanations are so, there's no need for any question. Any mic for?
Hello. Yeah. So this is more related to early stage of any startup. So let's say someone wants to have a new startup, and that is where the value of death exists. Like I'm a very small startup and I need to scale up. At that stage, what is your advice to the founders? How to navigate the uncertainties, and what should be your North Star metrics at that specific point, so that you can reach to a stage where probably you go for Series A or Series B. But the first, what are some death trap that we can avoid as founders, so that we actually navigate these scenarios?
Who wants to take this?
Hi. Now, as an investor, right, when we put money into any startup, I would want the maximum equity out of the money that I put in, right? So that is one debt trap that every investor is going to put on any startup. So I think you should be very cautious in diluting your equity, because as you scale up, as you require more funds, you would want that equity to get diluted, not now, but at a later stage.
Great. Any other question? Maybe one more. Okay, great. So I think that brings us to the closure of this great session on finance. Thank you all the panelists for their enlightenment, and thank you audience for your patience. Thank you very much.
Thank you, Mr. Bajaj, for sharing this wonderful discussion. I will now request Mr. Subhash Agarwal, Chairman of Globe International, and Mr. Satpal Bedi of Bedi Realty Warehouse Developers to please come up on stage and present our speakers with mementos and a small gift for coming here and sharing their insights with everybody when it comes to empowering startups and investment opportunities, especially for the logistics-focused startups. So please welcome Mr. Subhash Agarwal and Mr. Satpal Bedi on stage with a round of applause. I request you to please present mementos and gifts to our speakers who are on stage. A memento for Mr. Suresh Bansal, founder and CEO of DCGPAC. DCGPAC. A memento for Mr. Anant Bhatia of Bhatia and Bhatia. A memento for Mr. Raj Attri of CCI Group. And a memento for Mr. Shailendra Khinda of Anand Rathi Group. A memento for Mr. B.L. Bajaj of Dynamic Orbits Consultants. I request all of you to please gather for a group photograph. Request all of you to please gather for a group photograph. Thank you, gentlemen.